Welcome to our deep dive into the world of financial history.
Okay.
We'll be looking at Niall Ferguson's The Ascent of Money, a financial history of the world.
Sounds good.
Our goal is to uncover key insights about the evolution of money, banking, and financial crises, and understand what they mean for us today.
All right.
Would you say Ferguson's work is particularly relevant now,
Oh, absolutely.
especially considering the financial upheavals we've seen recently?
Yeah, I think it really reminds us that these events aren't isolated incidents,
Right.
but actually part of a larger historical pattern.
One of the most striking themes in the book is the cyclical nature of financial bubbles.
Yeah.
Ferguson draws parallels between events like the 2007 subprime mortgage crisis
Mm-hmm.
and historical bubbles like the Spanish silver bubble of the 16th century.
Uh-huh.
What makes this comparison so compelling?
Well, what's fascinating is that while the financial instruments involved may have been simpler centuries ago,
Right.
the underlying human behaviors, they remain constant. Take the Spanish silver bubble as an example.
Okay.
The influx of silver from the Potosi mines in South America. It created this sense of seemingly endless wealth for Spain.
And they just went on a spending spree.
Exactly. Spain went on a huge spending spree, but this influx of silver ultimately led to inflation and economic decline.
Oh, wow.
This reminds us that excessive liquidity, even derived from something as tangible as silver,
Yeah.
can create dangerous bubbles.
So are you saying that even real assets, like silver, can become subject to the same speculative forces that drive bubbles in more abstract assets like derivatives?
Precisely. The Spanish example shows that the source of the wealth matters less than the psychological impact it has on markets.
Interesting.
When people believe wealth is limitless, they tend to overspend and speculate, driving prices up to unsustainable levels.
Oh, I see.
This is a pattern we see repeated throughout history, and it's crucial for understanding the vulnerabilities of modern financial markets.
Ferguson also highlights how interconnected the modern financial system has become.
Yeah. Yes, definitely.
He uses the example of German regional banks and Norwegian municipal authorities investing in CDOs, which were ultimately backed by those same subprime mortgages in the United States.
Right, and this interconnectedness means that financial instability in one corner of the world can quickly spread, impacting investors everywhere.
Yeah.
The subprime crisis is a perfect example of how a seemingly localized problem in the American housing market triggered a global financial meltdown.
It's almost like a domino effect, where
Yeah.
one event triggers a chain reaction across the entire system.
Exactly.
This interconnectedness makes understanding financial history even more crucial, wouldn't you say?
Absolutely. Recognizing these historical patterns can help us better assess risk and make more informed decisions in today's complex financial landscape.
Now let's move on to another fascinating aspect that Ferguson explores: the evolution of money itself.
Okay.
He takes us on a journey from ancient Mesopotamian clay tablets used as debt tokens to today's virtual money.
It's remarkable, isn't it?
It's a remarkable story of how our concept of value and trust has transformed over millennia.
It really is.
What's striking is how those ancient clay tablets, essentially IOUs for commodities like barley or silver, were conceptually similar to modern banknotes.
Yeah, they represented a promise to pay, a debt acknowledged and recorded. This demonstrates that even in ancient societies, trust was fundamental to the functioning of any economic system.
And that trust has evolved alongside the forms of money we use. Today, electronic money dominates the financial system,
Uh-huh.
but it's essentially just information moving between accounts.
Mm-hmm.
What are the implications of this shift for the average person?
Well, this evolution speaks volumes about our increasing reliance on complex systems
Sure.
and the faith we place in them. While electronic money offers convenience and efficiency, it also raises concerns about cybersecurity, privacy, and the stability of the institutions that manage these systems.
Right.
The 2008 financial crisis, in part, stemmed from a loss of trust in these very institutions.
Ferguson also delves into the often overlooked role of credit and prejudice in shaping financial systems. He uses the story of Shylock from Shakespeare's The Merchant of Venice to illustrate the early history of money lending and the complex relationship between debtors and creditors.
Right. The story of Shylock, a Jewish moneylender in a society where lending at interest was considered a sin for Christians, highlights how financial systems often mirror societal prejudices.
Interesting.
Jewish moneylenders filled a necessary role in the economy,
Yeah.
yet they were often marginalized and vulnerable to exploitation.
It's a reminder that financial access and opportunity are not always distributed equally,
Exactly.
and historical biases can continue to influence modern systems. So, are you suggesting that even today, access to credit can be influenced by factors beyond pure economic considerations?
Certainly. While modern societies have made strides in promoting financial inclusion, historical inequalities and biases can linger, affecting access to loans, interest rates, and other financial services. Understanding this historical context is essential for creating a more equitable financial system.
It's a reminder that financial systems are not separate from the societies they operate within, and that social progress and financial progress are often intertwined. Now, let's explore another key development in financial history,
Hmm.
the emergence of the bond market.
Okay.
Would you say the bond market represents a significant evolution in how governments and corporations raise capital?
Definitely. It introduced a new way to manage debt and finance large-scale projects.
And that had a profound impact on economic development.
Oh, absolutely.
Ferguson specifically highlights the Rothschild family and their influence in the 19th century bond market.
Hmm.
They essentially created an early form of globalized finance by issuing bonds denominated in sterling and payable in London.
Their innovation was significant because it established London as a global financial hub, facilitating the flow of capital across borders. Their strategies set a new standard for international lending, laying the groundwork for the complex global financial networks we see today.
But this early form of globalization also carried its own set of risks.
Yes, of course.
The First World War, with its unprecedented levels of government borrowing, led to widespread defaults and inflation, eroding the wealth of many bondholders. What lessons can we draw from this historical experience?
Well, the experience of bondholders during the First World War highlights the inherent risks associated with sovereign debt, especially during times of geopolitical instability. It demonstrates that even seemingly safe investments can be vulnerable to forces beyond investors' control. This underlines the importance of diversification and a thorough understanding of the risks associated with any investment, especially government bonds.
It seems that even as financial instruments and systems evolve, certain fundamental principles remain constant. The need for a careful assessment of risk, an understanding of historical context, and an awareness of the interconnectedness of the global financial system are just as relevant today as they were a century ago.
Indeed. By studying financial history, we can gain valuable insights into the forces that shape markets and economies, enabling us to make more informed decisions in the present.
Now let's shift our focus to the concept of insurance, which Ferguson presents as a response to life's inherent unpredictability and the need to mitigate risk. He traces its development from early forms of fire and marine insurance to the modern welfare state.
The evolution of insurance reveals a fascinating interplay between individual risk management and collective responsibility. Early forms of insurance, like fire and marine insurance, were primarily focused on protecting individuals from specific, identifiable risks. However, as societies became more complex, the concept of insurance expanded to encompass a broader range of risks and uncertainties.
This expansion eventually led to the rise of the welfare state in the 20th century. Can you elaborate on how this shift occurred and what its implications were?
The rise of the welfare state was driven by a growing recognition that certain risks like unemployment, illness, and old age were not easily managed by individuals alone. The devastation caused by the First and Second World Wars further solidified this idea, highlighting the need for social safety nets to protect citizens from widespread hardship. The welfare state, with its systems of social insurance, pensions, and health care, emerged as a way to mitigate these risks on a societal level, fostering stability and social cohesion.
So would you say that the welfare state represents a significant departure from earlier forms of insurance by shifting the focus from individual responsibility to collective action and social solidarity?
Precisely. The welfare state embodies a shift in thinking about risk and responsibility. While earlier forms of insurance focused on protecting individuals from specific, identifiable risks, the welfare state aims to provide a broader safety net for citizens, recognizing that certain risks are shared and require collective action to manage effectively.
This is a crucial point to consider as we move forward and explore the challenges and successes of various approaches to social insurance, particularly in the context of globalization and evolving economic realities.
Indeed. The historical development of insurance, from individual contracts to the emergence of the welfare state, provides a rich context for understanding the ongoing debates about the role of government in managing risk and ensuring social well-being.
And those debates are far from settled. As we'll see, Ferguson delves into the challenges faced by the welfare state in the latter part of the 20th century, as well as exploring alternative approaches to social insurance that have emerged around the world. Ferguson highlights the pioneering work of two Scottish clergymen,
Mm.
Robert Wallace and Alexander Webster,
Yeah,
who created the Scottish Ministers' Widows Fund in the 18th century.
right.
This seems like an early attempt to address the risks faced by a specific group.
The Scottish Ministers' Widows Fund was groundbreaking for its time.
Okay.
It applied actuarial principles to create a sustainable fund, essentially laying the foundation for modern insurance as we know it.
Interesting.
Their model, based on careful calculations of life expectancy and contributions,
Yeah.
spread rapidly, demonstrating the universality of the need for financial security.
So we see the seeds of modern insurance being planted in this innovative approach to managing risk for a specific community.
Yeah.
But how did this evolve into the broader concept of social insurance and the welfare state?
The concept of insurance expanded beyond individual policies,
Right.
driven by a recognition of the need to address broader societal risks.
Okay.
The devastation of the world wars, coupled with the Great Depression,
Yeah.
highlighted the vulnerability of individuals to economic downturns, unemployment, and healthcare costs.
Actually.
Governments began to see a role for themselves in mitigating these risks, leading to the rise of state-sponsored social insurance programs and the expansion of the welfare state.
Ferguson uses Japan as an example of how the welfare state emerged amidst war and economic hardship. What's particularly interesting about the Japanese case?
Japan's experience demonstrates how a welfare state can contribute to economic growth and social cohesion, even in the face of adversity.
Oh.
Its comprehensive social insurance system, implemented amidst the challenges of post-war reconstruction,
Yeah.
helped to provide stability, foster a sense of shared responsibility,
Right.
and ultimately support Japan's remarkable economic recovery.
So the Japanese case suggests that the welfare state isn't just about providing a safety net.
Right.
It can also play a role in promoting economic growth and social stability.
Absolutely.
But as you mentioned earlier, the welfare state has faced challenges,
Yeah.
particularly in the latter part of the 20th century.
Yeah.
What were some of those challenges?
As the 20th century progressed,
Okay.
welfare states in many developed countries faced growing economic pressures, factors like globalization, increased longevity, and rising healthcare costs strained these systems, leading to concerns about their long-term sustainability. This sparked debates about the role of government in providing social welfare and the balance between collective responsibility and individual initiative.
Ferguson explores this debate through the lens of the Chilean experiment in the 1980s,
Okay.
when the Pinochet regime, under the influence of the economist Milton Friedman, implemented radical reforms to its pension system.
Right.
You mentioned earlier that Milton Friedman's ideas about free markets and limited government had a profound impact on economic policy. How did these ideas play out in the Chilean context?
Friedman argued that free markets and individual choice were more efficient and effective in allocating resources than government intervention.
Interesting.
He believed that social security systems, with their reliance on government management and redistribution, created distortions in the economy.
I see it.
His influence on the Chilean reforms reflects a broader trend towards market-based solutions for social welfare, a trend that has had significant implications for pension systems and other social safety nets globally.
So the Chilean experiment is an example of how economic theories can translate into real-world policy decisions with significant social and economic consequences.
Exactly.
The Chilean case highlights the complex interplay between economic theory, political ideology, and social welfare policies.
Yeah.
It demonstrates that there are different approaches to managing risk and ensuring social well-being, each with its own set of potential benefits and drawbacks.
Exactly.
The Chilean experiment, while controversial, ultimately had a significant impact on global debates about pension reform and the role of government in providing social security.
Right.
But let's bring our focus back to the events leading up to the 2008 financial crisis.
Okay.
Ferguson dissects how a confluence of factors, including loose monetary policy, financial innovation, and predatory lending practices, created a perfect storm in the U.S. housing market.
The subprime mortgage crisis is a cautionary tale about the dangers of unchecked financial innovation and the importance of regulatory oversight.
Right.
It highlights how seemingly localized problems, in this case, the American housing market, can have global repercussions due to the interconnectedness of modern financial systems.
You mentioned earlier that redlining,
Uh-huh.
a discriminatory practice that denied mortgages to residents of predominantly minority neighborhoods,
Right.
played a role in exacerbating the subprime crisis.
Yeah.
Can you elaborate on how this historical practice contributed to the uneven distribution of risk and the social consequences of the crisis?
Redlining, with its roots in racial discrimination,
Hmm.
created a system where borrowers in predominantly minority neighborhoods were systematically denied access to fair and affordable credit.
Right.
This historical bias made them more vulnerable to predatory lending practices,
Okay.
pushing them towards subprime mortgages with higher interest rates and less favorable terms
I see.
when the housing bubble burst.
Yeah.
These communities bore a disproportionate share of the burden,
Wow.
highlighting the enduring impact of historical inequalities on modern financial systems.
So the subprime crisis wasn't just about economic factors.
Mm-mm.
It also exposed deep-seated social inequalities.
Yeah.
And the ways in which historical biases can perpetuate themselves through seemingly neutral financial instruments.
Precisely.
The subprime crisis underscores the need for a more inclusive and equitable financial system that addresses historical injustices
Mm-hmm.
and ensures equal access to opportunity for all.
Absolutely.
Ferguson emphasizes how the securitization of subprime mortgages into complex financial instruments spread the risk far beyond the original lenders,
Yeah.
ultimately leading to a global financial meltdown.
Right.
Can you explain how this process contributed to the crisis?
Securitization involves pooling various types of debt, like mortgages,
Mm-hmm.
and transforming them into tradable securities.
Right.
This process, while intended to diversify risk,
Okay.
can also obscure its true nature. In the case of subprime mortgages,
Yeah.
the complexity of these securitized products masked the underlying risks associated with these loans.
Mm-hmm.
When the housing bubble burst,
Right.
the value of these securities plummeted,
Okay.
triggering a chain reaction throughout the global financial system.
So we see how financial innovation, while often lauded for its efficiency and sophistication,
Yeah.
can also create new avenues for risk-taking
Right.
and amplify the potential for systemic crises.
Indeed.
The subprime crisis demonstrates that financial innovation requires robust regulation and oversight to mitigate its potential downsides.
Absolutely.
Without adequate safeguards,
Mm-hmm.
the pursuit of profit can lead to excessive risk-taking
Yeah.
and ultimately undermine the stability of the entire financial system.
Ferguson's analysis reminds us that financial markets are complex, dynamic systems
Right.
that are susceptible to both irrational exuberance and herd behavior.
Yes, and history provides us with a rich tapestry of examples of how these behavioral patterns can lead to financial crises. Understanding these patterns is crucial for navigating the inevitable turbulence of markets and making informed decisions, both as individuals and as policymakers.
Absolutely.
And this brings us to Ferguson's exploration of the evolving global financial landscape
Okay.
and the rise of China as a major economic power.
Yeah.
Ferguson introduces this term, chimerica,
Yes.
to describe the increasingly intertwined relationship between China and the United States.
Right.
What are the key dynamics of this relationship, and why is it so significant in the context of global finance?
Chimerica represents a fusion of the Chinese and American economies,
Okay.
a relationship born out of mutual need and interdependence.
Interesting.
China, with its vast manufacturing capacity and growing consumer market, became a crucial source of cheap goods and investment for the United States.
Right.
In turn, the U.S. provided a stable market for Chinese exports and a source of capital for its rapid economic development.
So this symbiotic relationship fueled global growth for several decades, but it also carried inherent tensions, right?
Yes, absolutely.
What are some of the tensions that have emerged within this chimerican relationship?
One key tension stems from China's growing economic and geopolitical ambitions.
Okay.
As China's economy expanded, it sought to reduce its reliance on the U.S. dollar
Right.
and establish its currency, the renminbi, as a major player in the global financial system.
Interesting.
This ambition challenged the long-standing dominance of the U.S. dollar as the world's reserve currency,
I see.
creating potential friction points in the global financial order.
So the rise of chimerica represents not only an economic partnership, but also a potential shift in the balance of global economic power.
Precisely.
How does Ferguson see this playing out in the long term?
Ferguson raises important questions about the future of this relationship.
Hmm.
He suggests that the tensions inherent in Chimerica could lead to greater economic and geopolitical instability.
Okay.
He also highlights the challenges posed by China's economic model, which relies heavily on state intervention and control,
Yeah.
a system that may not be sustainable in the long run.
Ferguson's analysis suggests that the future of the global financial system hinges, in part, on the evolution of this complex relationship between China and the United States.
Definitely.
Are there any historical parallels that can help us understand the potential outcomes of this dynamic?
History offers some intriguing parallels.
Okay.
The rise of new economic powers often creates tensions with existing powers,
Right.
sometimes leading to conflict.
Mm-hmm.
The rivalry between Great Britain and Germany in the late 19th and early 20th centuries is a prime example.
Interesting.
However, history also shows that cooperation and accommodation are possible.
Yeah.
The post-World War II era saw the emergence of a new global financial order based on cooperation between the United States and its allies.
Right.
Whether Chimerica follows a path of conflict or cooperation remains to be seen.
It seems that understanding financial history is not just about learning from the past.
Yes.
It's also about using those lessons to navigate the complexities of the present and anticipate the challenges of the future.
Precisely.
Financial history provides us with a valuable framework for understanding the forces that shape markets and economies.
Huh.
By studying historical patterns, we can better assess risk,
Right.
identify potential vulnerabilities, and make more informed decisions in the face of uncertainty.
Absolutely.
As we conclude our deep dive into Ferguson's The Ascent of Money, what are some key takeaways that listeners should keep in mind?
Ferguson's work reminds us that financial history is not simply a collection of facts and figures.
Right.
It's a story of human ambition, innovation, and risk-taking.
Yeah.
A story filled with both triumphs and failures.
Right.
By understanding this history, we can gain a deeper appreciation for the complexities of the financial system and its profound impact on our lives.
Throughout this deep dive, we've explored a wide range of topics, from the cyclical nature of financial battles to the evolution of money, the role of credit and prejudice, the emergence of the bond market, the development of insurance and the welfare state, and the rise of Chimerica.
Right.
What unifying threads can we draw from these seemingly disparate themes?
One key thread that runs through Ferguson's narrative is the enduring power of human behavior.
Okay.
Whether we're talking about ancient Mesopotamians using clay tablets
Mm-hmm.
or modern investors trading derivatives,
Yeah.
human emotions like greed and fear continue to drive market dynamics.
Interesting.
Another important thread is the constant tension between innovation and regulation.
Right.
While financial innovation can lead to greater efficiency and prosperity,
Yeah.
it also creates new opportunities for risk-taking
Uh-huh.
and requires careful oversight to mitigate potential downsides.
And as we've seen, the interconnectedness of the global financial system means that seemingly isolated events can have far-reaching consequences.
Definitely.
The subprime mortgage crisis serves as a stark reminder of this reality. In today's interconnected world, understanding financial history is more crucial than ever.
Absolutely.
It provides us with a roadmap for navigating the complexities of the global financial system, anticipating potential risks,
Yeah,
and making informed decisions that can promote stability and prosperity.
I agree.
So as we conclude this deep dive, we
Yeah.
encourage you to explore Ferguson's book further and consider how the history of finance continues to shape our world.
Yes, by studying the past, we can better understand the present and prepare for the challenges of the future.
Remember, financial history offers valuable lessons, but it doesn't repeat itself exactly.
Right.
The future of finance will be shaped by new innovations, new challenges, and new actors on the global stage.
Absolutely.
By engaging with this history, we can become more informed participants in shaping that future.
Definitely.
Thank you for joining us on this fascinating journey through the financial history of the world.
It was my pleasure.
We hope you've gained valuable insights and a deeper appreciation for the complexities of this ever-evolving field.